Bismillahirrahmanirrahim. So today we'll study chapter 3 of this book, Why Minsky Matters, and this is about the financial instability hypothesis. So one of the main differences between the mainstream economic view and Minsky's view is that in the mainstream view, crisis is something unusual which happens. The system is basically stable and something happens which creates the crisis. But in Minsky's view, the system itself generates crisis automatically if left alone. So the mainstream view is that things tend to equilibrium, free market will lead to a happy outcome, but suddenly there might be an earthquake, so that will create so there's an outside event. But Minsky says that the system itself is inherently unstable. It automatically keeps generating crises, and so that is financial instability hypothesis. These are really contradictory views. According to mainstream, the system is inherently stable and it tends to equilibrium, and Minsky says that system is inherently unstable and tends to generate crisis if you leave it alone. So that means also that the role of government is very important, and we will see that the government has to be there to make sure that the crisis doesn't happen. Otherwise the system will automatically generate crisis. So basically he talks about that the regulations and the central bank behavior can act as circuit breakers, creating stability in an inherently unstable system. And this is the opposite of the Chicago view that free markets will work wonderfully if you just leave them alone. All the problems are caused by government interference in the free markets. Alright, so according to Minsky, institutions matter. The institutions is the central bank and the finance and everything, lots of details which are not mentioned. Your macroeconomic textbooks don't say anything. You just have this money, which is the variable, and in real business cycles even money is taken out of the picture. We just have these shocks which occur to the real relationships in the RBC models. So in the Keynesian model, the liquidity equals M. This talks about how the desire of people to hold money must be equated to the quantity of money. But this ignores a huge amount of things as to how money is created, how money gets into the hands of people, how people spend it. So all of these things, the real world experience of how people behave, how firms behave, what the institutions are, what are the regulations that are governing the system, all of these things make a huge difference, and any theory which doesn't have these will not be able to tell us about these things. So in particular, the ISLM, the LM curves gets rid of all of your finance, and then the ISLM tells us how to calculate the equilibrium in the money market, but it doesn't say anything about what is the disequilibrium and what happens when you are in disequilibrium. So there is this Samuelson multiplier accelerator model which does allow for explosive growth. What can happen technically is that you invest. When you invest, that increases the aggregate demand. Aggregate demand leads to additional investment. Now there is a multiplier process which multiplier is when you invest, then the aggregate demand gets hit by a multiple of this amount, and then the accelerator is the fact that this feeds again into additional investment. So there are two parts of this process. So this multiplier accelerator process can potentially lead to explosive growth, although it doesn't happen in the Samuelson model because the subsequent steps are damped. So you get an infinite set of reactions, but the later reactions are lesser and lesser. But if you change the assumption a little bit, you can get explosive growth. And the famous Harrod-Domar model, you have this knife edge equilibrium where If you go above, then it leads to explosive growth to infinity, and if you go below the equilibrium, then it leads to the other direction, explosive. So this yani when you compare the knife edge model to reality, then this is too unstable. The reality doesn't look like that. So Minsky says that there are circuit breakers. If the system is shooting off to infinity, then suddenly there's a barrier that is hit that prevents it from going. And similarly, if the system is going into collapse, again there are some circuit breakers which come in at that time. So the picture of the world that we get from the Minskyan theory is exactly the opposite of the free market equilibrium theory which you have all been taught, and which is the mainstream economic theory, that we leave things alone, they will converge to equilibrium. So when they leave things alone, then they're either exploding and going off to infinity, or they're going into crisis. And then so continuously you have this process that either the system is exploding and then circuit breaker comes in and prevents it from exploding, but then that means that there is a different type of mechanism that comes in, or it's going into collapse and then again a circuit breaker comes in. So there is no equilibrium anywhere. So there are floors and ceilings. This is an important part of Minsky theory, that when you have explosive growth, then there is a ceiling which comes in, which is some mechanism by the government and central bank to prevent the explosive growth. And then there are also ceilings, floors, where if the system is going into collapse, then again the government comes in and prevents complete and total collapse. So basically, if you look at World War II, what happened after that was that we had what seemed to be a stable period, a stable economy for a long time. But this appearances are deceiving. Now, what was happening was not that we had a smooth, stable, growing economy. Actually, the system was just as before. It was going off, and then there was a crisis, and then basically the government was able to manage the explosiveness and also the crisis. So on the surface, it seemed like there was a stable system, but actually there were lots of crises happening which the government was controlling, or the institutions were controlling. So basically, what happened was that the floors were created by Roosevelt's New Deal. After the Great Depression, there was this program, and in the New Deal, basically he said there should be a chicken in every pot. So basically there were lots of these welfare programs that were created. So this created the floors. If the system goes into the collapse, people will have food to eat by the government social welfare programs. And also there were ceilings. This was the prevention of the financial system from doing too much money creation. So there were many regulations which prevented banks from going too large. There was ceilings on the amount of interest that the banks could pay. There was AFDC aid to families with dependent children. There were unions which prevented the laborers from getting exploited overmuch. There was the Glass-Steagall Act which prevented the banks from speculating. FDIC, Federal Deposit Insurance Corporation, which made sure that if the banks collapsed, people would still get their money, and there was Social Security. So basically, the biggest stabilizer in the system, according to Minsky, are this big bank, which is the central bank, and big government. And these are the things which keep the system running. So this is, again, exactly the opposite of the view which people have, that you just let the free market run, and what you need is small government. If you have a small government, then the system will just collapse. It will go into crisis. And so you need big government and to control the system, and big banks to control the financial sector. And both of these are necessary to prevent the inherently crisis nature of the system. So he says that this is not enough. What happens is that the people in the finance sector are continuously inventing ways to get around the regulations. So there is there's no solution that you can say, okay, here is the laws and here's the regulation, here's the system that you can make, and this will keep things stable, because any set of laws that you make, the finance lobby will find a way to get around that, because when you are in an expansion, the finance lobby has the motivation to create money. And the second insight of Minsky, which is not understood by mainstream, is that it is always possible to create money. So you can always find a way, regardless of what kind of regulations you have, you can find a way to lend money to people. So the finance lobby is going to find some way, like these derivatives. And so when they find it, then you have to counteract that, and you have to make new regulations. So there is no final shape of the system. The only rule is that there is no rule. That's what he says. So the only regulation. So basically, just like these virus finders in the computers, there is a system. Every system has flaws. The virus people find a flaw, and then the patchers find a patch, and then they find a flaw in the patch, and then it keeps going. There's no stopping it, because you cannot design a perfect system which is foolproof. So this is a continuous process. The financial lobby will find a way to get around. So the central bank has to look at and make sure that find new ways to control what they have found. So basically, Friedman's rule is exactly the opposite of what needs to be done. This idea that you just keep money growth at 6%, this cannot be done, because as soon as you have stable growth and security, suppose that Friedman thing works and the bank creates a stable growth and stability and there is prosperity, then the financial lobby will take advantage of this prosperity to create more money, because in a growing and healthy economy, there is always room for more money. There is always the need for people will be wanting to invest, and the financial lobby will find a way to give them the money, and that will mean that your rule of money growth will be violated. And this is exactly what happened. The Fed can never meet the targets for money growth, because the system ensures that money will grow by getting around the regulations, whatever regulations you have in place. So the only universal rule for Federal Reserve is that it cannot be dictated by any universal rule. A rule would cause the behavior to change, and that would make the rule inapplicable. Policy must always adapt to what is going on. This is also remember the Lucas critique, that when you make a policy, then people react to this policy, and that's the basis of that's why macroeconomic models don't work. Now, one of the ways that the financial sector innovates and creates money is the interbank market. Here the banks can lend to each other and thereby create reserves. So how do banks create reserves? You see, what happens is that when banks lend, they use collateral. See, when I lend for a mortgage, then I get a house as collateral. So basically you have these financial instruments. The bank bank has given a loan to somebody. Now I am holding this piece of paper which says that Mr. X will pay me $1,000 1 year from now. So this piece of paper is my collateral. Now I don't have any money. This is the key thing, which insight which mainstream does not have. The mainstream thinks that when I lend 1,000, I had cash in my pocket and I lent it. But actually, the process is exactly the opposite. I first make the loan, then I look for the cash. So now I have this piece of paper. This piece of paper is the financial asset. Now I can sell it to anybody. Now, if we had no interbank market, which is the way the system, recommendation of Minsky, then I would go to the central bank and say, here is my piece of paper, please give me money in return for this. This is your collateral, you can give me a loan, however much I need. I don't need usually $1,000, I need usually a fraction of that. So now the central bank can examine my piece of paper and say, this piece of paper is not worth the paper it's written on. This man, he has collapsed and failed in so many places, so I won't give you any money. That will act as a circuit breaker. But now when the banks are doing interbank borrowing, then there is a general level which is accepted. Now when I give you a piece of paper, you give me money in return, then vice versa, then very risky investments can be made, because this is the current norm. What happened in the global financial crisis was the mortgage market was heating up and people were selling these mortgages, and it became clear to everybody this is not a sustainable situation. But on the interbank market, if everybody is taking something, you also have to play the game. You cannot drop out. So these financial innovations lead to endogenous money creation. Central bank loses control of the money stock, and these innovations lead to increasing fragility as you start taking more. You start innovating, and you start pumping more money into the system. The system becomes increasingly fragile. And the central bank tries to manage the situation and stabilize, but when the central bank tries to stabilize, it has additional effect that people get even more confident that we can take even more risks because there is somebody behind us to catch us if we fall. So they start engaging even more risky behavior. So he goes through the history and says in 1966 there was a municipal bond crisis. The cities were issuing bonds in order to finance their infrastructure developments, but they did not have enough revenues to cover the payment for the bonds, and so that led to a financial crisis, which was resolved by the central bank and in 1970 and 74. And crises kept happening, and they kept being resolved by suitable central bank interventions, which had exactly this Minskyan effect. So all of these post-war institutions that helped to stabilize the economy, they also created greater and greater risk-taking. It is much easier to put in a floor than it is to impose a ceiling. What you want to do is to say, okay, stop, no more expansion. But this is very difficult because people find ways, innovations, financial innovations, to get around these ceilings. And so Minsky thought that it was critically important to continuously change regulation and supervisory response to private sector's innovation. On the one hand, the private sector is innovating, is trying to find ways to get around the barriers, and on the other hand, you have to be on top of this, and you have to be watching, and you have to make sure that as they are getting around, you are making sure that they are not causing harm. But actually what happened in the post-war period was this, the opposite. The policy response was the opposite. As the institutions found out ways to get around rules and regulations, the response was to deregulate. You just get rid of the regulations. So that had disastrous consequences. So in 1975, when I got admission into graduate school, Minsky was putting forth these hypothesis which I never heard about in my macro course. Financial theory. It's very interesting because I was taking a course with Duncan Foley, who was our teacher of macro in Stanford in 1975 exactly. The first graduate sequence, exactly the course that you are taking right now. And what he said was, he was a conventional mainstream economist, and he had the Foley-Sidrowski paper is very famous for his, and that's a conventional paper. At that time, he was starting to think that the things that we are teaching in macro are wrong, and basically he said that let's go and read Keynes. Keynes had it right, and we have gone wrong since then. So our graduate course, we started reading Keynes, general theory, but I couldn't understand one word of it. So what I did was, I found this book by, there's a name that I've forgotten. It was an explanation of Keynes. John Hoofwood. It's a very strange name. So he had a idea about what Keynes said, and there's a book, and that was pretty easy to read and understand. So I read that book, and that helped me to pass my comprehensives. Otherwise, if I had just relied on what Duncan was saying and what the book was, it would have been hopeless. So what the Keynesian theory was the investment theory of the cycle. So Keynes basically said that investment is exogenous, and it's based on animal spirits, and investment can go up and down according to the mood of the public, and this is what causes the business cycle. And this was contrary to the standard theory and contrary to the ISLM theory that you have been taught, because according to all the theories, all the macro theories, everything is anchored. Everything. So investors know exactly what's going to happen in the future, so they make decisions according to the interest rate. That was what we discussed just a little while ago. So this was the key innovation of Keynes, that investment is exogenous. It comes from nowhere, and it can go up and down without any reason, and that can cause, that is the cause of the business cycle. So that was Keynes. However, that is not how Keynes was understood. The neoclassical synthesis taught us completely different, and we never knew what Keynes actually said. And basically, Duncan Foley was in the right direction, that if we could find out what Keynes had said, we would realize that it was not the same as what was being said about Keynes. And what Keynesian economics is not. Keynes himself said that I am not a Keynesian, because Keynesian economics was not the correct interpretation of his ideas. But unfortunately, Keynes was too difficult to read, especially for me, fresh graduate student. So what Minsky did was to add the financial theory of investment. So he said that investment takes place, but investment requires money. So where does this money come from? This comes from the financial institution. So there is this, the contribution of Minsky is to add something to Keynes on the finance side. So there are two key building blocks to the Minsky theory. There is two price system, price of current goods versus price of investment goods. And then there is lender's risk and borrower's risk. These are additional financial issues. Some of them are discussed by Keynes also. So the two price system is that the current goods, the consumer goods, and even the investment goods, the price of the good, the supply price of the good is the cost plus markup. So for any good, when we put a price on it, we try to recover the costs, and then we put in an overhead which covers the interest payments that you have to make on any financing that you took for this production. It has to have some profits, and this this pricing system covers consumer goods and services, and goods and services purchased by the government, and also investment goods, the producer cost. They are priced like this. But when you come to the demand for capital assets, so there are final goods which we consume, and then there are goods that we buy in order to invest, so factories and machines for production process. So now these come with a price. Price is just cost plus markup, but the demand price is now very different, because now these don't depend on our these are not final goods, so these are not we don't the demand for these depends on what we think about the future. This is the key difference between the capital good, that the same good with the same cost price will be more valuable if we think that the future is bright and there's going to be a lot of production that's required. So then if I have this factory, this machine, it will be working at full blast and I will be able to sell. Or if you think that the same good, the value of this good will be low if the future is not so bright. So every capital asset generates a streams of incomes and costs through time, and a future is unknown. So the price of this capital asset depends on expectations. So this is a key difference, because of the standard macro theories, you have rational expectations. So basically standard theory assumes that we know the future. So then we have a price which is just like any other price. So there is one price system, because everything is priced in the same way. I look at the cost, I look at the benefits, but what we are saying here is that I don't know the cost, I don't know how much I will have to pay for the financing and others. And if this is a long run, I'm building a factory for 5 years, I know the price of cement today, but I don't know the price of cement tomorrow. And I also don't know what the streams of revenue will be. So given that I don't know and I can't forecast them accurately, then it all depends on my expectations. So now capital assets are risky and not liquid. So basically there is a set of assets and they vary in their degree of liquidity. So cash is the most liquid assets, and bonds and financial assets are fairly highly liquid. You can easily sell them. But factories are not liquid and machine is not liquid. So when you make a non-liquid investment, then you need a lot more certainty about the future. So basically, when you have some doubt about the future, you will do what is called run to quality. Instead of investing in illiquid assets, you will prefer liquidity. So the pricing of the capital assets is entirely different and based on different types of considerations relative to the pricing of current goods. So there is a demand price, how much expected revenue will be generated. The lower the revenue and the more uncertain, the less the buyer will be willing to pay. Then also for big assets we need to finance them, which means you take a huge loan to build a factory, and now you're incurring a stream of payments that you have to make, and these payments you might think are going to be made out of the revenues that I earned. So there is a risk of insolvency and default. Maybe the revenue I get will not be enough to cover. So these are the borrower's risks. How much, when I take a loan, I evaluate the stream of payments, the stream of income that I will be getting, also I have to look when I'm borrowing, should I make a sequence of short-term borrows? I borrow for 1 year and then later on I take another loan to do the financing, or I take a long-term borrow. So all of these things, they have their costs and benefits. You might think that the financing will be cheaper in the future. You might think the interest rates are going down. So then you take a short-term loan and then you say that I'll refinance later. Also, you might have some doubts about your revenue stream, and you might say, okay, let's wait and see what happens, and I might maybe I'll shut this factory down if it's not working. Instead of taking a huge loan now, then I take a short-term loan and I default. So these are the borrower's risks. Now the lender's risks are of a different type. When I make a loan, then all of this borrower risk is there, but I look at the collateral actually and how valuable that is. And so the lender's risks are of a different type from the borrower's risk. So all of these, so there is the interest rate I have to pay, but also the risk factors are there, and then there has to be some margin. When you have stability, the economy is running stably, then all of these risks become small, and so then also you reduce your margins of safety. Whereas in an uncertain environment, you keep a large safety margin. And in a certain environment, when you have stability, you say, oh, everything is going fine, so it will keep going fine. And so you say, okay, this loan I will take, even though it may be risky. So you have greater risk taking in the purchase of capital. So when it comes to investment, so the Minsky theory is more complex than the Keynesian theory. So Keynesian theory say, okay, we have animal spirits, so we just invest when we feel like it. So Minsky takes this into a more refined form. So there's the supply price of capital goods, which comes from basically cost plus markup. See, just a side note, if we are just sitting down and starting to construct economics from scratch and we ask, how will we cost goods, then everybody will say, of course, we will take the cost and we will calculate a markup. This marginal cost pricing, this is just a weird theory. You have this production function and you're differentiating. Nobody, actually, when they went out and asked the firms, how do you cost, they had no conception of their production function. Nobody knows what the production function is. And that's what led to the Friedman as if theory, that it doesn't matter if the firms don't know, they have to, all that matters is that they should behave as if this is true. But this is just nonsense. It's just trying to justify a completely ridiculous theory. So basically MMT is just common sense, and macroeconomics is just a fairy tale. So supply comes from markup pricing, that's simple, but the demand comes from the asset price system, which is based on expectations. And these two prices, the supply price and demand price, are determined independently. They are completely different systems. How you produce goods, that depends on your real life factors of production, but the demand depends on your projections about the macroeconomy. So these are independent. So when you have optimism and reduced uncertainty, then the demand increases. And pessimism and risk leads to reduced demand. And borrowers and lenders operate with a margin of safety. The margin of safety goes down in periods of stability, and it goes up in periods of instability. So we already discussed the three financing profiles, that there is hedge finance, where you are able to pay both the interest and the capital out of your revenue stream. But remember, this is all expectations, because you have a revenue stream and you have a stream of payments. Even the stream of payments may not be known if you're doing repeated short-term financing rather than one long-term loan. and you might do that in some situations. So expected revenue streams covers your expected payments for interest and principal. Speculative finance is when the revenue stream covers the interest but not the principal. So here you are speculating that the asset prices will rise so that you will be able to pay. So in the future, or your revenue stream will increase in some other way that is currently not there. There were these when the global financial crisis was happening, when the housing market was going very rapidly increasing, there was the concept of the balloon mortgage, which was introduced and taken by lots of people. So you buy a house for $100,000 and you make installment payments for 1 year, and maybe that pays off 10,000 of the loan and 10,000 in interest, and then at the end of the year you have a big payment of 90,000 to make. So that's called the balloon payment. So you are financed for this 1 year, and then at the end you have to pay 90,000, and both the lender and the borrower know that you don't have $90,000 and you won't have $90,000 at the end of the year, but both are counting on that. Okay, at that point we will refinance. So if the house is going to be worth $200,000 next year, then it's a good deal for everybody. So that's speculative finance, but you're speculating that something good will happen in the future, but it may not. And then Ponzi finance is when you can't even make the interest payments on your loan, so you borrow in order to make interest payments. So this is what was happening towards the end. People were saying, okay, come in, take a mortgage, make one payment. As long as you can make a few payments, 2 or 3 payments, that's fine, because by the time I will be able to have sold this mortgage and I'll be out of the risk market. And this was why people were making Ponzi sales. They knew that the buyer could not, and the buyer didn't have understanding of this situation, and he also thought that the buyers didn't have the sellers, they had lots of experience with hundreds of thousands of loans, and they knew this guy is not going to be able to make. But the buyer was a first time buyer. He thought that I will be able to make payments. So when you make your payment, then basically they take down payment as much as you can, and so normally this would wipe out the life savings, and then in the end there would be a bankruptcy, and the person would lose all his money. So the Ponzi finance scheme is not sustainable, because you have to keep borrowing in order to repay your interest. And Minsky says that what is not sustainable will not be sustained. So as you have a system in which there is growth and there is stability, the financing shifts from hedge to speculative and to Ponzi. That is natural, and that's why the risks to the system increase. And this is basically the heart of the financial instability hypothesis, that the financing shifts towards the speculative and the unsustainable modes, and then the unsustainable is not sustained. Into this, Minsky added the Kalecki investment profit relationship, which I will briefly go through. The key MMT equation is the following. We have capitalists, and they consume CK, and the laborers, they consume CL, and the investment is done only by the capitalists, so the investment is IK, and then the government also invests in infrastructure, so the government has consumption and investment. So this is your basic expenditure side of the GNP identity. And then you have the income side of the GNP identity. So all of the expenditures made on consumer goods or on investment goods. Then the laborers earn wages. the capitalists earn the revenue from their sales of goods, and the government earns taxes from the taxes. So private sector savings are the wages minus what they consumed. The capitalist profits are what you earned minus what you consumed, again CK. And if I move the consumptions to the right hand side in this equation, I get that investment by the capitalist plus the government budget here. The government budget is what they consumed and what they invested minus their taxes. So that's their surplus actually. This is actually the deficit. What they spent minus what they earned. This is the government deficit. So this is equal to the profits of the consumers, of the capitalists, that is what they earned minus what they consumed, and then the savings of the laborers. So basically, the capital, assuming that the laborers don't save anything, this is what Kalecki said or assumed. Laborers don't save much; it's the savings really is. So basically, the relationship is that the capitalist profits is equal to the investment that you make, and then the injections by the government into the system. So capitalist profit is the sum of investments that you make and the government injections. So this is the Kalecki relation there. Profits is equal to investments plus injections. Now this is just an accounting identity. What really matters is the causal sequence. What causes what? So Kalecki says that the profits are things that are not in control, but the investment is a choice variable. So the capitalists choose how much to invest, and the government chooses how much to inject, and that together these two make up the profits, which is a consequence. So actually, what we need to do, what is not done, is that there needs to be a causal arrow in order to introduce. I will do this next time. So anyway, this is a rough explanation. We will try to get more detailed discussion and explanation of these causal sequences later. But we have discussed this, I think, in the previous course also. So our profits depend on our investments and on our government injections. So basically there are, when we want to invest, normally we have to borrow, and this borrowing will be based on speculation about the future. And then there is also, when you invest more, this will create investment demand and then multiplier effect, and then accelerator. And so earnings could increase more than expected. So suppose that I speculate and I borrow using speculative finance, and I invest, and I find out that at the end of the day my earnings are more than enough, because I made my calculations without taking into account the multiplier and the accelerator. And so I find that my speculation has been rewarded. What I thought was a risk, I find that I can cover easily. So this actually encourages even more gambling, because now I say, oh yes, so this is a good environment. And so firm speculation is rewarded and leads to increased speculation. In a booming economy, profits increase together with investment. And Kalecki says that the direction of causality is from investment to profits. And so basically a boom leads to a speculative frenzy. And this is, in Minsky's view, this is the heart of capitalism. Capitalism is about this process where you continuously have these speculative booms, and ultimately this collapses for one reason or the other, and then the process starts again. So this is the business cycle. The inherent tendency in capitalism is towards booms, not towards crisis. But the booms get hit by the balloon bursting, and then you have collapse, and then again you start the cycle again. When you have circuit breakers, you have things like the government deficit, which is an automatic circuit breaker. If you have a downturn, the deficit grows, and you have things like the Greenspan put, which we discussed last time, which will ensure that there is a downside. The downside risk is covered. That makes people even more confident that we can take risks, and we won't lose millions, we will lose a little bit. So it insures them against big losses, and encourages them to take even bigger gambles. So the Kalecki equation, as we said, is profits is equal to investment plus government injections. So there are two types of booms. This is important. So there is the boom that is created by the government injection. So the government keeps running larger and larger deficits, and that leads to a expansion in profits and expansion in business. Or there can be a credit-driven boom. If the businesses borrow to invest, they can create a boom in the economy. But this, so basically what Minsky says is that the government injections lead to a stable boom which can be sustained. But the debt-based boom is a risky boom because when you increase investment, that leads to increasing debt, and because of the boom, the government collects more tax, and when the government collects more tax, then the government injections go down, and this counteracts the boom. So this actually, big government acts as a stabilizer because it prevents it just slows down the boom. This is the counter-cyclical movement, and this acts as a circuit breaker. But basically, investment today depends on the profits and investments tomorrow. I mean, our expectations about them. And so this sets up the explosive change. There is a positive feedback change. As you invest more, you get stronger expectations about the future, and that leads you to invest even more, and that leads to an explosive chain of reaction. So basically, if you think about what Minsky's approach to investment, it's a very complex and dynamic temporal relation. So there is a circularity that I invest today on the basis of my expectation that investments will be high tomorrow as well. And this has a corollary in the banking and the financial system. Not only do we need high asset prices today, but we need to have high asset prices tomorrow in order to finance things today. This is basically, as long as you think that the housing boom will continue, you are willing to finance speculative investment on houses. So basically the financial system requires any future. It's not. This is the point that our loan today is based on expectations about what will happen tomorrow, and in fact, increasing prosperity is required for the speculative finance. So this is going to break, and when this breaks, then the whole system collapses. So if expectations go down about the future, then the demand price of capital goes down today. So this leads to lower investment, lower aggregate demand, and creates a downturn in the business cycle. And the point here is that where is the driver? Suddenly everything is going good. There is nothing wrong in sight that is visible, but people become pessimistic. This is, if you look at the East Asian crisis, actually the economies were just as solid before the crisis as they were after the crisis. But and the crisis happened in Thailand, but when the investor expectations about the future became gloomy, they just withdrew money from Indonesia and all of the East Asian, Malaysia, all of the East Asian countries, and they caused a collapse of the financial system without any basis in reality. So the theory of investment by Minsky incorporates the Kalecki theory of profits and the two-price system, which differentiates between the price of current goods and capital goods, and the intersectoral balances. Here the book refers to intersectoral balance, means the private surplus equals the government deficit. So all of this theory of how the system works has implications about how monetary policy should be done. So the first thing to do is to get rid of Friedman's monetary theory, which is common. I still don't know what they teach today in the textbooks. What did you guys learn? Did you guys learn this monetary money multiplier or not? You are still taught money multiplier, huh? Halanki, the Bank of England has published in 2014 that this
banking institute of Pakistan है वो उसका JIBP accredited by Chartered Banker Institute UK के साथ. Even then उनकी जो economics की books हैं उनकी अपनी recommended उनकी reference books हैं.
They are still teaching the multiplier. I don't know why people don't.
Bankers की certification है जो.
I don't know why people teach theories which are known to be false. It's really strange. So the Fed can control the money supply via reserves and multipliers. So there is some amount of reserves, then there is a multiplier. You apply the multiplier to get the money supply. This is not true, because the reserves are created by the in the interbank market also, and so the Federal Reserve does not have control of the reserves. So and actually if the interbank market was eliminated, then it would be closer to the truth, although it's still not guaranteed, because the margin which the financial institutions use, they can vary and they have many ways to get around the fractional reserve regulations. So basically the Friedmanite theory led to the use of open market operations. You control the amount of reserves by selling and buying bonds. So when we sell bonds, we soak up money from the market, and when we buy bonds from the market, every bank is required to hold a certain amount, I don't know, it's 10%, 16% of its assets in bonds. So there is always bonds in the market. So if the government wants to increase the money supply, it buys bonds, and so that puts reserves into the system. So that's the theory, but actually this theory is not valid because the quality of the loans, the riskiness, is something that you cannot examine. And the Federal Reserve Bank cannot control the level of reserves on the market. If they try to control reserves, the banks innovate to get around it. And ultimately, when the banks innovate and if they run real risks, then the central bank comes in and protects the public. Technically, we say that the banks protect the public. Actually, what happens is that there is a very close relationship between the central bank and the banking system. So, what is supposed to be happening is the central bank is supposed to prevent risky behavior, but what happens quite often is that the people who are the regulators are taken from the banking system to regulate, because theoretically they know the most about the banking system, and then after serving as regulators for a while, then they go back to the banking system. So their interests are aligned with the banking system rather than with the public or with the regulation. So the government insulates against financial risks, and this creates risk-taking behavior, and this creates an inflationary bias in the system, because basically the banks innovate to create credit, and when you have too much money, that will lead to an inflationary bias. And to counteract this, the government must use austerity, taxes, high interest rates. So once the financial system creates this boom, then the government has to step in and counteract. And this is what happened very recently when the economy was booming in Pakistan, and then suddenly we had to put on the brakes and increase the interest rate very high and try to control the deficit, etc. So this is the standard pattern. The history of this, what happened was that in 1980 there was a Friedman's policy. Volcker announced that he would use Friedman's policy. He would have a high interest rate to control the inflation, and there would be fixed targets for money growth. So since there is no money illusion, because money growth has been announced, so the level of inflation, remember that the key observation of Keynes is that when inflation takes place, there is no strike by the workers, because even though their real wage has gone down. So this was interpreted as saying that Keynes said that workers have money illusion, even though this is not what Keynes was saying. But it seems like what Keynes is saying. So they said, okay, now what we'll do is we'll announce that this is the level of inflation. So once this is publicly known, there will be no money illusion. And so unemployment would be eliminated, because the unemployment comes from money illusion. People think that real wages are different. But this did not work. The US went into the deepest recession that had happened since the Great Depression in 1980s. And the savings and loans industry was devastated, and there was a big savings and loan crisis because savings and loan had lots of these mortgages which were paying like 3% interest. So they had lots of capital locked in at low interest loans, but they were using refinancing, and now the refinancing that they had to do was at high interest, so they became financially insolvent. So this was the situation when Reagan and Thatcher came in, and what they said, Reagan said that, the problem is caused because the savings and loan industry is heavily regulated, and that's why they are in big trouble. So what we need to do is to deregulate the industry. So doing exactly the opposite of. So they deregulated saving, and there was a act by Reagan in I don't remember the dates, but he deregulated the industry. As soon as he did that, the SNL lobby went crazy. They started using their leverage to speculate. They bought Latin American bonds and lots of things. They made very risky loans, and then there was a huge collapse of the savings and loan industry. There was a severe financial crisis. The biggest, in fact, what's his name? The Black Swan guy. He wrote, Nicholas Nassim Taleb. Yes, he wrote in this book that this crisis wiped out the entire savings of the profits of the banking sector for 50 years since the Great Depression. But At that point, instead of letting them suffer, the government bailed out the savings and loan industry by a massive injection, some $87 billion or something like that. So this was an unnecessary crisis due to bad policy based on wrong theories. So what were the lessons from the Walker experiment? The Friedman's monetarist theory doesn't work because money is not a multiplier of the reserves, and the policy doesn't work in the sense that you cannot control money supply at a fixed amount because of the financial innovations. The Fed cannot control the money supply. Money supply growth is not a good predictor of either price growth or income growth. So these were the two things on which the so-called the triple. Now these were lessons learned in 80s, but we were still using the same theories in 2000, and these theories are still being taught 10 years after the global financial crisis. Not just in the Pakistan, but also all over the world. So this triple target cannot be achieved by a simple single weapon. So one thing that additional is that around this time there was a lot of discussion of the money demand function and how it has become unstable because of these, because the basically the multiplier didn't work, so all of your equations for money supply, they didn't match what the book said, and there was lots of confusion and lots of discussion in the literature about where is the missing money or where is the extra money coming from, because the equations didn't match your quantity equation, and nobody had any idea, and ultimately the subject was quietly dropped instead of being resolved. So what happened to the financial system after 1970 when the stagflation occurred and then the deregulation occurred? So Minsky's theory provided a good match to explain what we saw. So in the post-World War II there was low private debt, high government debt because the government had actually borrowed a lot of money to pay for war expenses. So this provides a safe and liquid financial assets, unlike private debt. What does this mean? Well, only MMTers can understand it, because when the government has debt, then basically that means deficit is high. Deficit means that the government has issued currency, so this currency the public is holding, this is government debt, so they have this financial asset which is the liabilities of the government, and so this is the injection which they have received, and this is a solid thing that the government will not default on its debt, so they can use this for trade. So this is a conducive environment for rapid growth without borrowing, because you can use the government debt. So there was this New Deal, which was social security, and also post-war reforms of the banking sector, regulations that made the economy stable. There was a safety net that stabilized consumption, social security, unemployment compensation, welfare, and food stamps. And there was strict financial regulation, minimum wage laws, support of unions, low-cost mortgage loans insured by the government. There's these institutions called Fannie Mae and Freddie Mac, which insure when the mortgages are made by financial institutions, they can get insurance to make sure that if the payments stop coming in, the government will insure them against that loss, so that they can make 30-year loans. This was a key innovation, because private financial institutions cannot make 30 years loans. There's too much uncertainty. So the government insured these loans, and that made the private sector able to give such loans. There were student loans which were given by the government, so that this enabled a lot of growth in the education sector. And also, people remembered the Great Depression which had happened recently, and they did not take risks. But gradually all of this changed. Stability breeds instability, as by Minsky. The memories faded, financial institutions started getting around regulations. The movement to downsize government replaced regulation with deregulation. Unions lost power and government support. Globalization introduced low-wage competition and increased uncertainties. And the safety net was, that is the social welfare, was underfunded by the government. So, Minsky, according to Minsky, these things would have happened anyway, but profit-seeking firms would and financial institutions would have taken greater risks. But all of the more, this was the protective net, the floors and the ceilings, the circuit breakers, they were also dismantled. So, in addition to the natural tendency of capitalism, there was the things which counteract this natural tendency were also removed from the picture. So the global financial crisis follows the patterns predicted by Minsky. Financial crises and recessions became more frequent, more severe, but the existing financial nets allowed the economy to recover relatively quickly from the crisis, and also the interventions by the government, the central bank, prevented and the full impact of the crisis from being felt. The savings and loan crisis was extinguished. People didn't find out about it. The government incurred a massive deficit, and that actually helped stabilize the system. The government put in billions of dollars to bail out the banks, and what people think is that now the government has bailed the bank out, and now we will have to pay taxes to refund this deficit. But this is completely a wrong picture of the economy, and this leads to the idea of sustainable deficits. So because of this continuous experience of stability, people took bigger and bigger risks, and ultimately this collapsed the system in 2007. Another great crash like the 1929. Minsky died in 1996, but the global financial crisis unfolded in a manner consistent with his projections, and many have called this a Minsky crisis. See, talking too much breeds non-talking. So, the mainstream, all of the 13 different schools of macroeconomic thought, none of them have this idea that if you are at a stable equilibrium, this will move towards instability. Once you are in stable equilibrium, you're dead. Only you will remain there forever. That's the meaning of equilibrium, that there is no tendency to change. In fact, the word, this is self-contradictory to say that equilibrium leads to disequilibrium, because the meaning of the word equilibrium is that the system is at rest and there is no tendency for it to change. But his theory says that no, equilibrium actually leads to disequilibrium. So this is unique among all theories. Now, for example, Stephen Keen, who has written Debunking Economics, he has a differential equation system which has this property that you have stability for a long time and then you have a crisis. So that provides a superficial description of a behavior that is like the grade moderation. You have a system which, but it is not an explanation. And this is something that I want to emphasize, that to you, that understanding always occurs at two levels. There is the observations, and then there is the reason for this observations. And this is never emphasized sufficiently. On the one hand, in your mainstream macro theories courses, you study only theories. These are only reasons why things happen, but you never study their relation with the observations. And on the other hand, you have economic history, where you study observations, things which happened, Great Depression, Allah Bala, but there is no match. So until you match the theory to the observations, you don't get understanding. And this is completely missing from the educational system as a whole, not just in economics, everywhere. You study math, but you study all the theories without studying how these theories are applied in the real world, or you study the real world, but you don't study the theory. And you have to put these together, and this is the main missing thing that is missing from education as a whole. So here we are putting things together. We have the real world phenomena, global financial crisis. We have a theory which explains why this happened. And as far as I know, Minsky is the only one. So, money matters. Keynes saw that very clearly. He said that money is used to finance investments. But Keynes says that money is never neutral, because if you are underemployed, first of all, he says that there can be underemployment, which mainstream doesn't admit. So if there's underemployment, then there's underinvestment, and when there's underinvestment, that has a permanent long-term effect on the economy. So if you intervene properly and you inject money into the system, then you can build up the long-run growth of the system. So money matters in the short run by eliminating unemployment, and it matters in the long run by increasing the capacity of the economy. But this is not understood at all by mainstream. So now Minsky extends the Keynesian theory, because he talks about all of the financing aspects which are not part of the Keynesian theory. Keynes argued that one of the conditions for a stability of the economy is stickiness in wages. Basically, because this is going to prevent your debt deflation cycle, which happens in a crisis. But unfortunately, people misunderstood Keynes, and they thought that sticky wages causes unemployment, which is actually opposite of what Keynes said. So Minsky extended Keynes by arguing that even if you get to full employment, this would generate destabilizing forces, restoring unemployment. So this was not part of Keynesian theory. So the main instability in a modern capitalist economy is a tendency towards explosive euphoria. Now, there is a book by Schiller called Irrational Exuberance, which basically explains how the economy is going into an explosive pattern, and there is no rational basis for it. So now Minsky explains how this happens, and that this is just not irrational, this is a key characteristic of the capitalist system. So high aggregate demand and high profits will raise expectations and will encourage increasingly risky ventures based on commitments of future revenues that are too optimistic. And basically, you see, what happens when the productive capacity of the economy is exhausted is that you start making investment in stocks and land and other speculative assets, and the prices start rising, even though they have no relation to reality. And so, on the one hand, it seems that this investment is paying for itself. So your investment is justified because the asset prices are rising. So the euphoria self-justifies for a while until you have the collapse. This is also what happened in East Asia when a huge amount of money were poured in from when financial regulation, there was strict capital controls. Foreign money could not enter the economies. But when the foreign money came in, it went into land, property, buildings, and the prices shot up. And when the prices shot up, that's justified. So when the investment that they made an investment, they got high returns. But when there was a crash, then these same asset prices collapsed. So the point is that this is a normal pattern. This is how capitalist economies behave. So what I was saying is that, you see, one might think, and Keynesian theory leads one to believe, that full employment is the circuit breaker. Once you reach full employment, then then you should just stabilize. This is true if the government is controlling the money supply, then they can stabilize the system at full employment. But if the private sector is in control of credit creation, then they can take the system past full employment and generate explosive growth in the financial sector, even though the government is trying to choke the money supply. So there is this natural tendency that the boom will generate, and you have boom, the economy goes out of control, and then you have to put on the brakes. And this is exactly what happened in Pakistan recently, and this is the natural consequence of this. When I'm saying that this is exactly what happened, the big picture is much more complex than that. There are many factors other than that. So this is like the simple Keynesian description, but there are many more complicating factors. All right, now we have 15 minutes, so what I will do is I will stop this and give you a small presentation of something else that